All right, good afternoon, everybody. Foggy day, foggy day. So this afternoon, President Biden delivered a major address on his economic legacy. After decades of trickle-down economics, President Biden has written a new playbook that's growing the economy from the middle out and the bottom up. His administration has delivered the strongest recovery in the world and laid a strong foundation for years to come by investing in America, empowering workers and unions, lowering costs, and supporting small businesses. Over the last 4 years, we have made remarkable progress, and the results speak for themselves. Over 60 million jobs created, the lowest average unemployment rate of any administration in 50 years, inflation down faster than almost any other advanced economy, and incomes up almost $4,000. The list goes on. As you heard the president say, we face an inflection point. Do we continue to grow the economy from the middle out and bottom up, or do we backslide to trickle-down economics? With that, I will turn it over to Jared Bernstein, Chair of the Council of Economic Advisors, to further discuss the economic progress that we have made. Jared?
Thank you. Great to be here with you again. I want to thank my team, as always, for helping me to prepare to speak to you today. The president, as you just heard, gave a legacy speech today wherein he spoke about the strong economy that his administration is leaving to the incoming team and how we got here given what we faced when we took office. He then lays out a set of benchmarks, which I will go through with you in a minute, against which the incoming administration's economic stewardship should be judged. The speech makes clear that while the pandemic was the acute source of economic stress 4 years ago, the damage done by decades of Republican fealty to trickle-down economic policy was a long-term underlying source of economic pain for millions of Americans. The speech goes through the policy implications of that agenda, offshoring jobs with no concern for workers in their communities, anti-unionism, and disinvesting in American infrastructure, workers, industries, and contrasts that with the Biden-Harris agenda of middle-out, bottom-up growth, which implies a very different agenda, investing in workers in key industries of future growth and productivity, union power, full employment labor markets, fair taxation, and taking on corporations and lobbies like Big Pharma on behalf of the American middle class. The timing is not accidental. As Karine said, a quote from the speech, with the outcome of this election, we face an inflection point. Do we continue to grow from middle out and bottom up by investing in all of America and in all of Americans, supporting unions and working families, or do we backslide to an economic theory that benefited those at the top while working people in the middle class struggled for a fair share of the growth? The president, as his speech, at the end of his speech, the president ticked through a set of benchmarks, indicators by which the conditions of the current economy that the incoming team has inherited can be assessed and judged. 16 million jobs with a manufacturing and a construction boom. In 4 years, we'll know if that job growth and booms will continue or not. Historic lows in unemployment, record new businesses, significantly closing the racial wealth gap, more people covered by health insurance than any time in history. Our tax code is fairer. We've gone after concentrated corporate power, and in 4 years we'll know if this power goes back to big corporations or not. Let me end my introductory comments today with a little bit of a reflection on the economics, speaking as the chair of the CEA, of the economic theory behind what the president talked about in his speech today. I should say the economic theory and the economic outcomes is as far from just a theoretical or an academic exercise. The president talked about achieving a soft landing, and this is the idea of considerably lower inflation without giving up much on the economy's demand side. That is, lower inflation without higher employment. As you know, many economists told us we couldn't get there. We'd have to have a recession to have as much disinflation as we've seen. In fact, that did not occur. And one of the reasons it didn't is because the job market, you know, I heard the president mention full employment a couple of times in his speech today. The job market has stayed uniquely strong for uniquely long. And that's given workers bargaining clout along with his union agenda. And so as prices have come down, as inflation, I should say, as inflation has come down and wages have gone up, we've had real wage gains now for about a year and a half on a yearly basis. Last seen 1.5% real year over year. That's real. That's a considerable pace of real wage gains. This helps support strong consumer spending, and that's been a core factor keeping this economy moving forward above trend growth rates and leading to a situation that you heard the president talk about today where the U.S. economy really is the envy of the world. And I say that as someone who recently came back from Europe, where I was frequently accosted by people who wanted to just talk about how we've achieved the innovation, the productivity, the persistent full employment that we have. That's the consumer side of the story, the consumer spending side of the story. It's 70% of our nominal GDP, so it's extremely important to keep the economy moving forward. But I often think of consumption as today's story and investment as tomorrow's story. I think what the president talked about today, that was so important and so compelling, especially given the fact that many of these benefits are going to unfold 2, 4, 5, 10 years from now if the incoming folks nurture the seeds we've planted versus take them out. This investment agenda has the potential and is already transforming economic growth, production, innovation, building up new domestic sectors in this economy in the area of clean energy, battery production, chips, and that kind of investment agenda, that speaks to future growth rates. That speaks to future opportunities. That speaks to future productivity growth. Now, we've already, as the president said in his speech today, there's been $1 trillion of private investment that has flooded into those sectors, into clean energy, into semiconductors, into providing infrastructure for this country. All of that, again, is a complement to the consumer spending side of the agenda, the soft landing agenda that sets us up for a future based on the kinds of investments the president talked about today. With that, I'll turn to your questions.
Good to see you, Jared. Thanks for doing this and subjecting yourself to all of us. One of the benchmarks that President Biden didn't mention in his speech was the U.S. budget deficit, which is closing out the fiscal year last year like above 6% of GDP. How sustainable is that as an inheritance of the incoming administration?
The president spoke about this a bit in the speech in the context of doubling down on the TCJA tax cuts, of course, most of which expire at the end of next year. And he talked about I think he mentioned $5 trillion in deficit-financed tax cuts if Republicans fail to offset that. I think that stands in stark contrast to the budgets that we've passed that have the most recent one with $3 trillion of deficit reduction. So the first point is that if you look at the fiscal outlook that we've tried to craft in our budgets, now obviously we're not able to get those through Congress, but we certainly, that's what we've been fighting for. They're characterized by significant deficit reduction and a great deal more fairness in the tax code, which is something he talked about today. So I think he correctly took a stance that the full extension of the Trump tax cuts would be both significantly damaging our fiscal outlook and even worse, creating more unfairness in the tax code and increasing after-tax inequality. In terms of whether 6% deficits are sustainable, I think that when what you really want to see, I think it's hard and probably not that advisable to say this number is okay and that number isn't. Once you get to this level of debt to GDP, you're in trouble. Once you go over it, the markets don't really work that way. Given the extent of the debt that we face so far, we still have very successful auctions to explain what I'm talking about. But I do think that what you want to see is when you get to a full employment economy with above trend growth, you'd like to see that number coming down. So I think it's much more of a delta story. You'd like to see that number coming down, and one of the reasons you don't is because decades of trickle-down economics and Republican tax cuts have severed the linkage between strong economic growth and revenue flows to the Treasury. We've tried to correct that in our budgets, but the politics have blocked us from getting it there.
But basically, you believe the current situation is not sustainable based off your budget proposals.
I think that when you get to an economy, I think that when you're an economy like ours, no, I wouldn't say it that way. I would say when you're an economy like ours, with all the kinds of indicators the president discussed today, full employment, above trend GDP growth, historically low unemployment, yes, your budget deficit should be going down because the revenues that come into your coffers are outpacing your outlays, and that's the budgets that we've written. That's something we've tried to embed in our budgets, and we haven't been able to get them passed. What's worrisome, and the President talked about this today, is that the incoming administration is making sounds of going in the other direction, which I would consider fiscally reckless.
Yeah, Jared, it's been a little while since I've seen you, so I want to ask you a question about the speech and the context for it. I mean, so many voters cited inflation and just their pessimism about the economy in exit interviews as we were watching the election. So what is the purpose of sort of going out and saying, well, we did all this right against that backdrop? It's kind of like water under the bridge, right? Sort of your account of the economic progress is against the backdrop of people having said, no, that's not what we want to do.
Well, as I tried to express in my topper here, in my introductory remarks, the purpose was really twofold. One was to lay out a set of benchmarks. I mean, I think the president quoted Reagan in the speech saying sometimes facts can be stubborn things, but they are facts. So lay out a set of facts that are unequivocally correct about above trend growth, trending at 3% on real GDP, lowest average unemployment in 50 years, 16 million jobs, and so on, real gains in average income of $4,000 since we got here. Lay down a set of facts, benchmark 20 million new businesses, small businesses created. Lay down a set of benchmarks against which the progress of the incoming administration should be judged. I mean, this is the incoming team, in no small part, ran hard against this economy, and so it's entirely possible that in some short amount of time that they start making very different sounds about how they own these great results. And we wanted to be sure that we set down the benchmarks that the Biden economic agenda delivered. Secondly, how did we get there? So those are the benchmarks, but how did we get there? We certainly didn't get there with trickle-down economics. We got there with the new playbook that Karine and I referenced, and that's a playbook that invests in American workers. It invests in American bargaining power. It believes in union strength. It believes in fair competition. It believes in fair taxation and a more reasonable fiscal outlook. It believes in pushing back on concentrated corporate power. All of those parts of the Biden economic agenda got us to where we are in terms of the positive indicators that we had in this, that we outlined today. Now, at the same time, nobody is denying the inflation that you asked about, and in fact, the president hit that head on in two ways. One, first, he talked about our efforts to get inflation down. So remember, in mid-June, you saw inflation peak, and after that, it turned around and came down pretty quickly to now it's within target. It's close to the Federal Reserve's target rate, and that's why you see them cutting rates. And so how did we get there? Well, we did a great deal of work on trying to unsnarl supply chains. The president talked about his release of oil from the strategic reserves, and of course, a full set of cost-cutting measures going after junk fees, health care, and so on. The incoming administration has talked about repealing measures that would directly raise costs, not to mention adding a set of sweeping tariffs that would act like a national sales tax, pushing the wrong way on inflation. So it seems to us entirely important to reference all of those developments in this case.
Can I just follow up? So, given that there's this lag in the economy, like something happens and then there's a lag when you see the effect. How long will it be before, say, Trump's tariffs sort of make themselves felt? Because I think the White House itself looked at the possibility of repealing or removing the U.S.-China tariffs to sort of address inflation and realize there would be only a very modest impact. So,
okay, so first of all,
what's your
sure, I can
prediction
give
for
you
the
some
lag?
economics on that and the lag structure. First of all, it's really important in this conversation to distinguish between targeted tariffs that are designed to protect American industry and American taxpayers' investment against unfair overcapacity trade practices of the type that China has engaged in, with sweeping tariffs of multi-digit % tariffs on everything coming in from Europe and China. Totally different worlds. The first protects American producers. The second hurts American consumers. How quickly does that happen? Quite quickly. So let's talk about how a tariff works. And again, I think we've gotten some misguided explanations in this regard from the other side. The other country doesn't, the exporting country doesn't pay the tariff. Technically, the tariff is paid by the importing company. It's paid upon customs receipt by the importer. Now, that business then typically pushes that tax or tariff forward to their consumers. And that's why studies have shown that fairly quickly, I don't want to cite a number, but I think it's months versus, I don't want to cite a time period, but I think it's more months than quarters. So pretty quickly, I think we've seen in the past. Oh, you know, it's a good example is the washing machine tariffs. That they hit very quickly. I think it was a matter of weeks or months before we saw the price effects on washing machines and on dryers, American dryers, even though they weren't tariffed. So the price effects work pretty quickly.
Good, MJ.
Thank you. Thanks, Chair.
Hi, MJ.
Hi. Nice to see you. You know, over the last year or so, I think we've all seen you field a lot of questions about this disconnect between what you describe as a strong economy versus the people's generally pessimistic economic outlook. I just wondered, and it's related to the last question, what would you say is the reason that there wasn't enough of an improvement in people's economic outlook by Election Day? I assume you've had some time to reflect on the results of the election.
It seems clear, if you look not just at our election, but at elections and approval ratings across the globe, that not just inflation, because by the time the election came along, inflation was back down within distance of 2%. So it was back down close to the Fed's target. So not inflation, but the price level, the cumulative impact of inflation. So the fact that people could still remember what things used to cost, that was a force that really whacked incumbents in every I think virtually every election we've seen across the globe. So that was a very powerful force. Now look, from our perspective, we needed to do two things. We needed to get inflation down, because you'll never get people will never be able to acclimate to the higher price level unless inflation comes back down to around 2%. And that was behind our work on unsnarling supply chains, which became very important in this space. One of the graphics that I like to tout from our CEA team is if you look at supply chain measures of stress, which go way up and way down in the pandemic and post-pandemic, and you plot them against commodities goods inflation, they track each other very closely with a bit of a lag. And so getting inflation back down to target was very much an important part of agenda. But that just means prices are rising more slowly. It doesn't mean they're falling. And in fact, to have a broad decline in the price level, you would need a deep recession that nobody wants. So what you need to happen is for incomes to catch up. Now, those dynamics were happening. They were occurring. And I've spoken about this from the podium before. I theorized, probably a couple of years ago, and one of my colleagues and I are trying to write an academic paper about this. I theorized a couple of years ago that if inflation came down and people had enough time to acclimate to the new price level, an acclimation that would be very much aided, and in fact was essentially, had to be aided by rising real wages or incomes, eventually they'd start to get acclimated and to feel better. And sort of what's the word I want? Sort of a trivial example of that is when I started driving, gas was 60 cents a gallon. But I don't walk around annoyed that gas isn't 60 cents a gallon because while prices have gone up, incomes have gone up more. That's where we are. Inflation is back down. The price level remains too high from the perspective of consumers and voters. And that's partly, big part of the answer to your question. I sense you want to say something else.
This long